here on ET Now continue, and we have the management of UCO Bank. We have Mr. Ashwani Kumar, who's the Managing Director and CEO at UCO Bank, coming in to talk to us about the numbers, of course, for Q2 FY26, which have been quite strong. To give credit to UCO Bank, 17% growth, sir, on a YOY basis, 11% on the deposit side, 17% on the advances side. We're seeing very, very strong growth underlying, which is continuing to remain solid for you. Do we have Mr. Ashwani Kumar? If we do, let's take it across. There you go. Good morning, Mr. Kumar. Give us a sense. Is this growth which you are seeing sustainable? The kind of double-digit growth that you've clocked, it's not just double-digit. It's 17%. It's well above mid-teens. Can that kind of growth continue for you for the rest of FY26? Give us an outlook. Give us a sense of how it's playing out.
Good morning, and thank you for having me on your show. First of all, let me wish you and your team and all viewers happy Diwali and happy Bhaiya Dooj. With regard to the growth of the bank, you have seen that we have been consistently growing in all segments for the last 7-8 quarters, and growth is not less than 15% in any of the quarters in the credit segment is concerned. When we are looking at the growth, composition of growth, then the RAM segment is also growing and corporate segment is also growing. So RAM segment growth is always more than 25% on a consistently for the last 7-8 quarters. And within RAM, our housing loan growth is around 18% consistently. Vehicle loan growth is more than 20. We started with 22%. Now we have reached to 70% growth on a YOY basis. And then coming to our agri is also growing around 17-18% this quarter also. MSME, which was slightly slow on a slow lane till last 3-4 quarters, but now for last 3 quarters we have been consistently growing in MSME also more than 18%. So all segments are well poised for growth, and there is a good demand considering the GST cut and the government which initiative of the income tax exemption also. So this quarter also we have seen in current season also we have seen a good amount of traction in the vehicle loan growth and housing loan growth.
Morning, Mr. Kumar. If you can also take us through your interest margins as well. There's a 6 pip decline on a quarter-to-quarter basis. How do you see the trajectory for the margins?
See, if you ask me about the margin, our NIM has been in the range of 3%. Now this is 2.90%, and we expect that now the credit impact on the credit interest income on the loans, it has already been taken care. Now it's an impact of deposit which will be repriced now in this quarter and the next quarter. So I believe that the NIM will continue to be in this range. There will not be any degrowth after this quarter, and repricing of the high cost deposit will come in this quarter and the next quarter. So NIM should be in the range of 2.9, and it may inch up a little bit also because in March quarter we will have a major amount of repricing in the deposit segment.
And so you'll exit FY25, FY26 with 3% NIMs?
I expect that we should be touching 3% exit NIM in the March quarter.
And how do you look at credit cost also? Means while it has fallen, do you see further decline in credit cost numbers for you as well?
See, credit, if you look at my net NPA, it has come down to 0.43%, and our target is to reach to 3.3%. And given the total amount of absolute amount of net NPA figure of less than 1,000 crore, I believe that our credit cost will continue to decline further on a quarter-on-quarter basis.
Okay. So talk to us about fresh slippages. Absolutely any concern there? I fully understand. You have guided for around 1 to 1.25% of fresh slippages this year. You've done 1.05, so I must give you credit for it. But give us a sense, can that kind of number hold up? Any concerns on credit quality that you're seeing at this point?
See, you look at my slippage around 2 years or 3 years, 2 years back it was 1.75%. We have been consistently bringing down the slippage ratio, and now we have reached to 1.05, and our guidance is 1 to 1.25. And I am confident looking at the quality of our book And you can look at our SMA levels also, more than 1 crore. We are always giving a figure of more than 1 crore SMA. That book itself is only 1800 crore. That works out to 0.77% of my total standard book. So there is no concern on the book is concerned. If you look at our composition of SMA more than 1 crore, majority is in retail agri MSME, and hardly anything is in the corporate credit segment. So the quality of the onboarding is also good, and it is well controlled also.
Sir, two questions bundled into one. One is with regard to your credit growth. You've guided for 12 to 14%. You seem to be confident of doing 15% plus. At least that's the feeler I got from what you've been saying. So would you therefore venture and hike the guidance, if at all I can call it that? Is it a formal hike, or do you believe that you'll stick to the 12 to 14 just because you're being conservative? Because 15 plus seems very, very likely. The other piece I want to talk about is recovery and upgrades. That's the other place where you've seen very strong traction. You've done 1600 crores this quarter versus the 22 to 2700 crore which you've guided for the full year. Do you believe that on both of those metrics you'll well beat your guidance?
See, if you ask me about the credit growth, revising the guidance, let me tell you now, currently, if you look at the data published by RBI, the credit growth is 11.5%, and we are at around 16+%. Last year also, we guided 12 to 14%, we surpassed our guidance. So this year also, we are confident the way we have continued till now, we will be surpassing our guidance this year also. But we will not like to revise our guidance. We will continue with the guidance on a conservative basis, 12 to 14%, and that we will try to see that we are above the industry average in credit growth is concerned. That is helping us on two fronts. One, our CD ratio was quite low 2 years back. It was around 65%, and now we have reached to 75%. So we intend to reach to 77% CD ratio also. So that is one. Second, we will see that as we have grown in the past, we will continue to grow in all segments, not only in one particular segment. Proportionately, it will be a proportionate growth in all the segments. That is another thing. Now coming to the recovery and upgradation, this year we have given a guidance of 2200 to 2700 guidance. That guidance was slightly on the lower side, considering that if you recall, in March we had a good amount of recovery in one large NPA which we were expecting in this year. So that was taken care in last year. But this year also, in the first 2 quarters, we had a good amount of recovery. So we will surpass our guidance this year also. So 20, upper band of our guidance, I will say, that we should be reaching to the upper band instead of the lower band. So that will be our endeavor, as our team is very confident that we will be achieving that guidance.
Okay, thank you so much.